The 2008 financial crisis was a seismic event that shook the global economy to its core, and its effects are still felt today. As we delve into this topic, it's essential to recognize that the repercussions of that tumultuous period extend far beyond the headlines of the past. Millions of individuals lost their homes, jobs, and savings, leading to a profound shift in how people view financial security and stability. Fast forward to today, and we see the lingering impacts manifesting in various ways. Many individuals are still grappling with the consequences of foreclosures and bankruptcies, which have left lasting scars on their credit scores and financial confidence. The crisis also ushered in a wave of regulatory changes aimed at preventing a similar disaster, but these regulations have also created a more complex financial landscape that can be challenging to navigate. As we explore this topic, we invite you to reflect on how the lessons learned from the 2008 crisis continue to shape our economic realities. With rising inflation, fluctuating job markets, and the ongoing effects of the pandemic, understanding the roots of these issues is more relevant than ever. This video aims to provide you with insights into how the past informs our present and future, encouraging you to think critically about your own financial decisions in today's economy. Join us as we unpack the lasting legacy of the 2008 financial crisis and its implications for individuals like you. Economic impact. The 2008 financial crisis left an indelible mark on the economy, and its effects continue to ripple through the lives of individuals and families today. One of the most significant impacts has been on job markets and wages. In the aftermath of the crisis, many people faced prolonged unemployment or underemployment, leading to a shift in job security perceptions. While the economy has recovered in many areas, wage growth has been sluggish, failing to keep pace with inflation. This has created a challenging environment for families trying to make ends meet. Housing markets also underwent a dramatic transformation due to the crisis. The initial wave of foreclosures led to a surplus of homes, driving prices down. However, as the market has rebounded, affordability has become a pressing issue once again. Many families find themselves priced out of desirable neighborhoods, struggling to secure stable housing in an increasingly competitive market. The dream of homeownership, once a cornerstone of the American dream, feels out of reach for many. Additionally, the crisis had lasting effects on savings and retirement plans. Many individuals were forced to dip into their savings or delay retirement due to financial instability. The fear of another economic downturn has led to a more cautious approach to investing and saving, with many families prioritizing short-term security over long-term growth. As we navigate this complex landscape, it's crucial to understand how these ongoing economic effects shape our financial futures and the decisions we make today. The 2008 financial crisis not only reshaped the economy but also had profound psychological effects on individuals and families. One of the most significant impacts has been the rise in anxiety and stress related to financial insecurity. Many people experienced job loss, foreclosure, or significant reductions in income, leading to a pervasive sense of uncertainty about the future. This anxiety can manifest in various ways, from sleepless nights to chronic stress, affecting overall mental health and well-being. The financial strain has also taken a toll on relationships and family dynamics. Couples facing financial difficulties often experience increased tension and conflict, which can lead to breakdowns in communication and trust. The stress of managing finances can create a ripple effect, impacting not only romantic relationships but also connections with children and extended family. Families may find themselves arguing over money, leading to feelings of resentment and isolation. Moreover, the long-term effects of financial trauma can significantly influence decision-making. Individuals who have experienced financial hardship may develop a heightened fear of risk, leading to overly cautious behavior in their personal and professional lives. This can hinder opportunities for growth and advancement, as the fear of repeating past mistakes looms large. Understanding these psychological impacts is crucial for fostering resilience and promoting mental well-being in the face of financial challenges. As we explore these themes, it becomes clear that the scars of the 2008 crisis extend far beyond the balance sheets, affecting the very fabric of our lives and relationships. Changes in financial behavior. The 2008 financial crisis fundamentally altered how people approach personal finance and spending. In the wake of the crisis, many consumers experienced a significant shift towards saving and frugality. The fear of economic instability prompted individuals to prioritize building emergency funds and reducing debt. This newfound emphasis on saving has led to a more cautious approach to spending, with many opting for needs over wants and seeking out value in their purchases. Alongside this shift in spending habits, there has been a notable increase in financial literacy and education. As people sought to regain control over their finances, many turned to resources like online courses, workshops, and financial blogs to better understand budgeting, investing, and debt management. This growing awareness has empowered individuals to make informed decisions, fostering a culture of financial responsibility that was less prevalent before the crisis. Additionally, the rise of alternative financial services and budgeting apps has transformed how people manage their money. With traditional banking options sometimes falling short, consumers have embraced technology to track expenses, set savings goals, and even invest. Apps that offer budgeting tools and financial insights have become increasingly popular, allowing users to take a proactive approach to their finances. As we analyze these changes in financial behavior, it's clear that the 2008 crisis served as a wake-up call for many. The lessons learned during that tumultuous time continue to shape how individuals navigate their financial lives today, promoting a more mindful and informed approach to personal finance. In response to the 2008 financial crisis, significant regulatory changes were implemented to address the systemic issues that contributed to the economic downturn. One of the most notable pieces of legislation was the Dodd-Frank Wall Street Reform and Consumer Protection Act, enacted in 2010. This comprehensive law aimed to increase transparency and accountability in the financial sector, with the goal of preventing future crises. One of its key implications was the establishment of the Consumer Financial Protection Bureau, CFPB, which was created to oversee and enforce consumer protection laws in the financial industry. The Dodd-Frank Act also brought about substantial changes in lending practices. Lenders are now required to adhere to stricter guidelines when issuing mortgages, including verifying borrowers' ability to repay loans. This has led to a decrease in risky lending practices that were prevalent before the crisis, ultimately protecting consumers from predatory loans and ensuring a more stable housing market. Additionally, the regulations have enhanced consumer protections by mandating clearer disclosures and more straightforward terms for financial products. Consumers are now better informed about the risks associated with loans and credit cards, allowing them to make more educated financial decisions. These regulatory changes have significantly shaped the current financial landscape. While some argue that they may have restricted access to credit for certain borrowers, the overall effect has been to create a more stable and transparent financial environment. As we navigate today's economy, understanding these regulations is crucial for consumers seeking to protect themselves and make informed financial choices. As we wrap up our exploration of the lasting impacts of the 2008 financial crisis, it's clear that its effects continue to resonate across various aspects of life. From the ongoing economic challenges faced by individuals and families to the psychological toll of financial insecurity, the crisis has reshaped how we approach personal finance. We've seen a significant shift towards saving and frugality, an increase in financial literacy, and the rise of alternative financial services that empower consumers to take control of their financial futures. Understanding these effects is crucial for making informed financial decisions moving forward. The lessons learned from the crisis can guide us in navigating today's complex economic landscape, helping us to avoid past mistakes and build a more secure financial future. We hope this discussion has provided valuable insights into how the 2008 financial crisis continues to influence our lives today. Thank you for joining us, and we look forward to seeing you in our next video.